welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. Stocks are jumping today with the S&P 500 on pace for a run of gains not seen in 20 years.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Well, the initial read is another set of sigh of relief here for the markets. I mean, you've got more jobs than expected, although the revision sort of offset that, the revision lower. So it's kind of a push there, but enough. The unemployment rate stayed stable. Monthly hourly earnings, average hourly earnings went down a little bit, so that sort of helps the inflation picture. Bottom line, from a market's point of view, is the stock market is looking right now for any excuse to rally.
We don't have a rate cut this summer. We don't have a rate cut in June. We have one rate cut in December of this year. So the data certainly today do not point to an imminent rate cut. With the inflation outlook where it is, and the Fed very concerned about the inflation outlook in the context of being above target over the previous 4, almost 5 years, they're going to be focused on that first and foremost. And with the labor market still holding in, there's no reason to cut whatsoever.
I think they're going to need to take margin pressure. I think you're going to see their earnings per share fall because I think it's better for them to maintain their installed base by cutting price and driving unit sales during this period of tariffs. So I expect Apple to eat some or all of the tariff increases and then let the extra costs fall to the bottom line. But on the consumer side, I think they'd be smart to keep the prices steady.
We got 1 hour to go until the market close, so let's take a look at the major averages. And we are seeing this rally today in the face of a little bit of a sigh of relief on the jobs numbers. We're going to dig more into those in a moment. But the Dow right now up 541 points. It's up 1.25%. The S&P 500 up 1.5%. And as we've been talking about today, I'm just going to kick it out to no, that's not going to work. I'll kick it out to a 1 month here. And we've seen this run in the S&P 500 that's lasted now 9 days. So that's the 20-year streak that we were talking about. We haven't seen a streak like this in that period of time with the gains that we have seen. Now, if you look at a year-to-date chart for the S&P, we're still negative. So it's coming off the low levels, but nonetheless, we've talked to a number of people in recent days who have said the lows are probably in here. We'll see if that ends up being true. The NASDAQ, meantime, also up 1.5%.
Right, and of course, the big jobs report today, the April jobs report, that was a good report. I mean, I think you looked at that report and said the U.S. labor market still looks resilient, right? I mean, the headline beat. There was no change in the unemployment rate. There are caveats, of course. There always are. The 2 prior months were revised down. Big picture, to the extent you see tariff impact, that could still be in the pipeline. But clearly, I think you saw investors just look at that report, looked over the details, and you did feel this just kind of sigh of relief there.
Yeah, and then in addition to that, there was a report in the Wall Street Journal today that China is starting to maybe make some moves or some overtures to address the tensions between the U.S. and China. This one seems aimed at fentanyl production in China. It sounds pretty tentative and early, but it is at least incrementally movement in the direction that investors
I think investors looked
go.
at that, Julie, and just said, okay, well, maybe there's signs here that the two sides could at least start talking, start engaging after a period of what has felt like an impasse, right?
Yes, definitely. And then, of course, there are the earnings from 2 big companies that are not going in the way investors would like. You see Apple here, which you just heard Laura Martin of Needham talking about, down 4.25% on some concerns that they will, even given their size, et cetera, that they will feel some pain from tariffs. The company indeed said they could see up to $900 million in costs related to the tariffs.
And the uncertainty too there, Julie. I mean, I think a lot of it is Tim Cook saying after the June quarter, I can't tell you here what the tariff impact is going to be. I think that's also what you're seeing in the shares.
Yeah, because they don't know what the tariffs are going to be. And Amazon, likewise, not down as much as it was earlier. In fact, it's a little changed right now. So their investors are looking at this a little bit differently here, but nonetheless, still weighing all of these factors. We're seeing the rest of big tech perform pretty well today. And as for the sectors, we've got all of them in the green. Consumer staples doing the worst, but still up 0.6%. Financials, industrials, communication services leading the gains.
All right, well, for more on the latest market action as investors weigh data and earnings, let's welcome in now Jordan Jackson, JP Morgan Asset Management Global Market Strategist, as well as Gregory Dacco, EY Chief Economist. Greg, we'll start with you as the resident economist today on the panel. Greg, I'm just curious, that April jobs report, Greg, what did you make of it? Did it generally dovetail with your expectations, Greg?
Yeah, I mean, I think it generally was a reassuring report, but I think the past tense is very important here. It was a good report indicating what could have been in terms of the labor market and the broad economy. We're in an environment where the tariffs are really starting to bite in the latter part of April. And as we look forward, we're going to see much more of a visible impact in terms of economic activity and in terms of employment in the coming months. So this is what could have been. It was a good report, but I think to some extent it's a bit of a mirage.
Jordan, maybe talk us through, given that this is backward looking, you would think from what we've seen in the markets, things are looking pretty good, meaning that 9-day run that we have seen, or 9-session run, in the S&P 500. So what is that reflecting if there are still some risks that are out there?
Yeah, I think the market is continuing to look more and more ahead, perhaps even as far as into 2026. I mean, we kind of know that we've got this 90-day reprieve. There'll be negotiations going on. We don't really know the severity of the inflation impact. We know there's probably going to be a bit of cooling in the labor market, but everyone is very much sort of muddling around this soft, modest sort of recession. Nothing, really deep in terms of meaningful slowing in economic activity. So I think that allows us to look at this reconciliation bill working its way through Congress. If the economy can get to, say, the fourth quarter, and now you've got fiscal stimulus, perhaps juicing things up for 2026, I think the markets can get a little bit more excited about that and look past this near term.
So, Greg, let me ask you, clearly investors saw that report this morning, and there seemed to be a sigh of relief, right? But when you looked at the report and other economic data, just add it up for us, Greg. Do you see an economy that's just slowing? Do you see an economy tipping into recession? What are you telling folks?
Well, the economy was slowing before the tariffs, so that's the first thing to keep in mind. It was a strong economy, it was moving towards potential, but it was slowing. And now we have this unique shock to supply, and that is going to lead to a massive disruption in terms of economic activity. Whether we get a recession or not is still up in the air because there could be, and we think there will be, some rollback of the tariffs on China and on the rest of the world over the course of the coming months. But you still have this massive shock that will lead to slower capex, slower hiring, and slower employment growth. Those are going to be the catalysts that lead to much more caution in terms of consumer spending activity. So we're going to see the slowdown in terms of the materialization of economic activity. One thing that I'm concerned about is that when you look at the data and you have this rearview mirror, you're going to be very reactive as a Fed policymaker, and you might have this impression that the economy is still very robust, when the reality is, and we've seen that in cargo volumes, we've seen that in hiring intentions and capex intentions, the reality is that there's going to be a sudden stop in economic activity that will only be visible over the coming months.
We've been talking a lot about the capital T tariffs, the 145%. I want to ask you as well about the de minimis exemption, which goes away today, right? So this is shipments and goods of under $800. Yes, it's the Temus and Shins in the world, but it's also a lot of small businesses in the U.S. that import goods and send them to their customers. So where should we look for that in the data, and what effect do you think that's going to have?
I'm glad you mentioned small businesses because we tend to overlook them quite a bit. We focus a lot on big corporations that have lobbying power, that have buffers, that are able to withstand these shocks. Small businesses do not have that ability. If you look at small businesses, they represent about 50 to 60% of employment in the U.S. And if you take businesses up to 500 employees, you're talking about 80% of employment in these small businesses. These types of shocks are massive for these small businesses, and it's not a question of whether you delay investment, you delay hiring as a small business. It's really a question as to whether you can continue your operations. Do you have enough cash on hand to be paying these tariffs when they come into your doors? And the reality is that, unfortunately, many businesses are going to come under increasing pressure from the tariffs on China, from the end of the de minimis exemption, and from all of the tariffs that are being imposed on all of our trading partners. There's nowhere to hide from a small business perspective side, and we've already started to see it in terms of the economic data. The ADP report earlier this week showed that small businesses were shedding jobs. Other businesses were still hiring.
Greg, Jordan, Greg mentioned the Fed, big meeting next week. I'm just curious what you expect there. I mean, Jay Powell has clearly signaled, listen, monetary policy is on hold.
Yeah, I think this report pretty much solidifies that they're not going to move next week. I think the Fed's probably going to lean a little bit more in Powell's camp in terms of they can be patient, they can be cautious here, they don't need to overreact. I'm still in the camp that the Fed's got 2 cuts in the chamber this year. I think they go in September, I think they go in December. I think they want to wait things out over the course of the summer before they try to react, because what they don't want to do is find themselves in a situation where they cut too much this year. Now you've got, helping them potentially stimulating some demand on the back of fiscal support, juicing up the economy, be additional tax cuts next year. Then they've got to come back in 2026 and hike rates again. I think they really want to avoid that. They also want to avoid using the word transitory. They've gotten penalized before for using transitory before in 2022. And so I think, they've got to kind of acknowledge the continuous deal making happening and the gradual pullback that's going to have an impact, probably a lingering impact on inflationary pressures. So I don't think they want to use transitory, but we still think you're going to get this pop in inflation in the near term, but things still should start to subside later this year and into 2026.
What do you think, Greg?
Well, I very much agree that the Fed is going to be reactive. So I think a later onset of any rate cuts is more likely. But I think there are 2 elements that we have to keep in mind. One, I'm not so sure that there will be persistent inflation from these tariffs. Why? Because the labor market is softening. This is very different than the post-COVID shock when you had a lot of fiscal impetus in the economy and a lot of drive to hire people where the bargaining power was on the employee side. This is not the same labor market that we had a couple of years ago. So you're not necessarily going to see much wage pressures coming from these goods prices that are higher. They're actually, in my opinion, going to detract from demand, destroy demand, and lead to a disinflationary shock once we're past the initial hump. And the second thing that I think we have to be very keenly aware of is that we're talking about an extension of the Tax Cuts and Jobs Act and perhaps some additional tax cuts. But in terms of the fiscal stimulus to the economy, it's not nearly as much as it was back in 2017 when we passed the initial set of tax cuts, because we're just talking about extending these tax rates, and that in and of itself is not stimulative.
Jordan, add it up for us. When you're talking to your clients right now and they ask you, listen, how do I want to be positioned in the stock market broadly? Jordan, what are you telling them?
I think right now you maintain that kind of defensive over cyclicals, value over growth, large cap over small. But I do think there's going to come a time later on this summer where, again, markets are going to be very much focused on what do the next 12 months, some of 2026 in there. And I think there will start to be an inflection point where you can start to add risk again. I'm still in the camp that I think the worst is behind us because we kind of know what the worst looks like. That's April 2nd. That's draconian tariff rates. That's a really deep recession. And I think the hard part coming into the year was we didn't know what the pain point really was. Now we may not be 100% sure where the pain point is, but we know there is a pain point, right? And so I think we can take a little bit of solace in that the worst is behind us. We also know, in every correction going back, excluding early 2000s, the equities bottom before GDP and payrolls, right? And so if we're staring down, we know kind of the biggest weaknesses is coming. I think the markets again are starting to look a little bit ahead.
Are clients sort of buying into that idea? In other words, the markets have sort of been whipsawed, right? There was a lot of enthusiasm and optimism seemingly after the election. Then there was the rude awakening of tariffs, April 2nd. And now we sort of seem to be coming to this uneasy equilibrium. Are you still hearing a lot of concern from clients, though? Or do they seem more reassured, I guess, right now?
Well, our clients have maintained their diversification. And if you've been diversified over the course of the year and not just owning U.S. stocks, maybe you've got some bonds in your portfolio as well, you're not down all that much so far year to date. Maybe you're down somewhere between 3 and 4%. And so you've weathered this storm, fairly decent. So clients, interestingly enough, aren't, overly concerned here. So I find, encouragement in that aspect. But again, I do think there will become a time where you can start to rotate back into some risk. The near-term challenge, though, is the E and the PE. And right now, you still have analysts on the S&P calling for about $265, $266 earnings on the index. I struggle with corporate America making more money this year than they made last year. And so if that E's got to come down, you're probably still paying about a 21x multiple on the market right now. And so I think that's where the next sort of bout of volatility can happen in the near term. But again, I think this is sort of a market where you certainly can't time, maybe dollar cost average into some of the more areas of the market that have been hit a little bit harder, and then you can start to re-risk a little bit more a little bit later on in the summer.
Guys, lots of good stuff today. Thanks so much for both of you for being here. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, it was a wild week for big tech earnings. We're going to recap the numbers with an expert on the other side and look ahead to more earnings next week. Stick around, more Market Domination still to come. After a busy big tech earnings week, Wall Street is reassessing its sentiment on tech titans such as Apple. Shares of the iPhone maker sliding as it warns of a $900 million tariff headwind this quarter. Our next guest, though, says this is still a top tech pick for 2025. It is Dan Ives, Wedbush Managing Director and Senior Equity Analyst. And Dan, it's great to see you. And there's a lot to dig through in terms of big tech earnings. But let's start with Apple here. I believe you raised your price target. We see the stock pulling back a little bit today. And just like everything else, a lot of uncertainty here, an environment where Tim Cook doesn't feel comfortable really projecting very far out what is going to end up happening.
Yeah, and Julie, me and you have talked about it a lot. Like, I actually think Apple should be up today. Because when you look at the India pivot, I think this is Hall of Fame. I think the history of Apple, this could be one of Cook's biggest accomplishments, given what we're seeing in terms of the tariff tornado. And in terms of the $900 million, if you told me April 2nd, $900 million would be the incremental cost, that would be like a gift. I mean, my thought was potentially $2 billion. So I get it, just in terms of the reaction, but to me, like a week from now, I think the stock's higher than it was before they printed last night.
How much of this, Dan, do you think comes down to the uncertainty of Apple executives on that call saying, listen, we can't tell you what that tariff impact is going to be past the June quarter?
And look, Josh, you know Apple as well as anyone, right, over the decades. Like, there's just no way Cook is going to give anything outside June because, first off, they don't know the rules of the game. It all comes down to China negotiations. They're pivoting as quickly as they can to India. But I continue to think, like, they're pivoting to India, and India is probably going to be one of the first trade deals done. And I think it would be, very, very surprising, and I think probably, not the smartest thing, if they gave any guidance past June. Because I think that the fact that they gave guidance at all, I think is a huge positive.
Dan, what do you think iPhone growth looks like, let's call it, over the next 4 quarters? Because there are some analysts, Dan, who think it's going to remain relatively muted until that personalized AI, that updated Siri comes to iPhone.
I disagree on that, just because my view is, like, look at the China number. I mean, you go back to last quarter, down 11%. Constant currency was flat. Like, the irony is, like, China is actually, you're now getting to a point that you used to have a year-over-year increase in China. So I think when you look at steady state growth, it's going to be, call it, mid to high single digits as we go into, let's say, the next 3-4 quarters, but eventually double digits. Now, clearly, AI is going to play a huge role there, but it goes back to, like, services, despite whatever, a slight miss. I mean, that is Rock of Gibraltar like. Look at the free cash flow. And I think you put it together. I mean, there's a stock that's closer to 300 than 200 over the next year.
Dan, we've been talking about margins and tariffs. What about demand, right? Because we know that consumer sentiment is certainly not great right now in the U.S. So what do you think U.S. sales are going to continue to look like?
Yeah, and look, and that's part of from a tariff perspective. I mean, Apple gets it on both sides from the supply chain perspective, but then of course consumer confidence goes down. $1,000 iPhones, obviously those are going to be tougher and tougher, in terms of the price points. Look, I think it comes down to when you look at the install base and you look at how many have an upgrade in, call it 4 years, you're still close to what, 275, 300 million? So even if you take more negative view, you're going to be looking at 235, 240 million iPhones sold and I think get 250 million as we go into next year. When I put that together, I mean, relative to the numbers that we're seeing today, I think now, like, Street's cut numbers and it's set up outside of tariffs for actually this probably starts to be a bottoming process in terms of growth.
Dan, broadening it out, which is the big tech earnings report this season that impressed you the most? Was it Apple or another name?
Microsoft. I mean, that was a shocker.
How come?
That was a Saquon-like quarter, right? I mean, the point is, when you look at what you saw in Azure, 200 bit beat, accelerated over the coming quarters, the abandoned data center story, the Pinocchio story, that's done. So the point is, like, that was for Nadella. That was, I think, just a pivotal moment to show what's happening at Microsoft, what demand looks like. Look at that guide. I mean, I think this is a stock that's actually going to get stronger and stronger. And look, in software, that continues to be a safety blanket trade in this storm.
Switching gears, we want to get through a lot with you because we know you cover a lot. So I want to ask you about Tesla because you know, of course, we're saying that Musk needed to recommit to Tesla. He seemingly did so, right? Although still 1 to 2 days a week in DC is not nothing. Then comes the report that the board had been exploring, searching for a replacement for him potentially. The board said, no, that's not the case. What do you make of all of this sort of back and forth? It feels a little messy, Dan.
Yeah, of course it's messy. I mean, and again, is smoke, how much is fire? Look, Musk is spending 1-2 days in D.C. with Doge, the same chances that I'm playing for the Knicks in the playoffs. Like, I mean, his days of Doge are essentially done in the Trump White House. So that's my view, and it comes down to, like, however the board did it, shareholders, part of why we were so adamant and so loud is because the brand damage hit a point where the clock struck midnight. He had to choose. He did a phenomenal job on the call, and I think that was probably one of the best conference calls that he's done, choosing Tesla. He continues to be the biggest asset for Tesla as CEO, autonomous, optimist future. But when you get into, like, board, what happened, the reality is, like, look, there was massive pressure. And I think Musk felt it. And I also think, look, Doge took on a life of its own. I don't think he ever expected the consequences from a brand perspective and what this was going to become around the globe.
Do you think that there's been a lot of criticism of the board, that they had not done their due diligence in the past, that they had not sort of overseen him enough, that they were all too close to him? Does this kind of report show that they're at least making an attempt at trying to...
it shows, like, not asleep at the wheel.
Yeah.
Or like, Julie, you're exactly right. Like, I think that's always been the knock on the board, like rubber stamp board. Like, you know, Musk basically rules it. It doesn't matter. Now, regardless of, like, what's true, what's not, look, I think the reality is, like, the board had their back against the wall. They had to make, I think, decisions, and there was pressure. And I think Musk felt the pressure too. And that's why that was a much different Musk on that conference call than I've probably ever heard in terms of the beginning. And I think he read the room, and the future of Tesla should not be taken down because of Doge. And I think that's the reality. And I think he chose the right path.
Dan, another name you know very well, scheduled to report on Monday. That would be Palantir. Still a buy, Dan?
Messy of AI, right? I mean, look, Josh, this is one, like, I think it's going to be $1 trillion market cap in the next 3 to 4 years. I mean, they could just continue. The haters hate on this one. They continue to doubt it. Talk to any CIO, any product manager out there, and ask about Palantir. I mean, their solution set and algorithm is unmatched. And when it comes to all the Brahmas movement, the AI revolution, CapEx, that is all going into their sweet spot. And that's why they're the Messi of AI.
Dan, always great to see you, buddy. Have a terrific weekend.
Great to see you. You too.
Well, Big Oil capping off a big earnings week. We're going to get you the results and a reaction on the other side. Stick around. Much more market domination still to come.
Big Oil capping off a big earnings week. Exxon, Chevron, and Shell all reporting first quarter results this morning. For more on the energy sector, we're bringing in Rob Thummel, Senior Portfolio Manager and Managing Director at Tortoise Capital. Rob, it's good to see you. It's so fascinating, the energy sector, because the hopes were high for the sector coming into the Trump presidency, but it hasn't turned out quite so great, especially if you look at oil prices. So just briefly, when you look at the three that reported today, what stands out to you and who do you think is sort of faring the best?
Yeah, well, it's good to see you, Julie. So you're right. So the energy sector's has had high hopes, but remember, it's still really important. There's nothing really that happens in the economy without energy. But to answer your question, Exxon had a really good report. It's not performing the best as you just showed on the list, but Exxon continues to be, at least from the big three, probably best positioned to really persevere through what are going to be some difficult, maybe economic times, at least uncertain economic times, and some uncertain commodity price periods. And so Exxon's really well positioned. They continue to buy back stock. They bought back 1.6 times the amount of stock they bought back in the same quarter last year. They continue to pay a really good dividend. They grow that dividend every year. They've done it for decades, and so they're probably the best position to be resilient in these uncertain times.
Rob, what about Chevron and this Hess deal? How is this going to play out?
Yeah, Josh, that keeps going, doesn't it? We keep talking about it. Hopefully we'll have some resolution this year on the arbitration. It's really difficult to figure out how it's going to play out. Mike Wirth seemed to be pretty confident that it's going to play out in their favor. You probably saw that, or that actually Chevron bought 5% or 4.99% of Hess stock during the quarter. And so I think Chevron believes that they're going to prevail, and that ultimately that they will be the owner of Hess sometime in 2025.
In the background of all of this is the OPEC Plus meeting that's going to be happening, and there are some concerns that production is going to be boosted, right? And this at a time when we already have seen oil prices come down amidst the trade war going on, concerns about demand. What do you think is going to happen there, Rob? And then what does that mean for these companies?
Yeah, lots of uncertainty here, and I guess that's what 2025 is. I guess the year of uncertainty, and it's carried over, spilled over into the oil markets. So what's OPEC going to do? OPEC Plus going to do? Hard to tell, but the expectation is, and I think our expectation is, that they will add an additional 400,000 barrels a day back to the market. So that's in addition to the 400,000 that they just brought on. They'll bring another 400,000 barrels a day on. I think what OPEC Plus is trying to do is they're trying to get compliance with the group. And everybody back to the agreed upon production levels that they agreed to actually years ago now. And so I think we will have an oversupplied oil market for a while. That's going to put pressure on prices. Now, the cure to low prices is, well, it's low prices. This could help boost economic demand for oil and for gasoline. And hey, by the way, this is a great thing for consumers, because gasoline prices are going to be going down into obviously the strongest season of the year for driving.
But doesn't it also mean that if prices are going up for other stuff and prices are going down for oil, could it be that people don't then drive more because they just see it as a way to save some money because they're spending more in other places?
That's possible, Julie. But remember, oil is kind of sneaky in that it's a product that's used in a lot of consumer products as well. And your premise, it could be accurate, and it likely will be better than mine. But oil is actually used in a lot of other consumer products. So if oil prices just come down in general, it actually helps inflation in a positive way, or helps reduce inflation in a positive way, more than just at the gas pump. It's in other consumer products as well. So that could help going forward as well, and keep prices lower. That's kind of what has really the U.S. shale really helped keep consumer prices low, not only just in the U.S. but around the world for decades, because of the fact that the U.S. found all of this new oil, and oil prices have been relatively low for a series of years, despite some spikes that we've seen.
Rob, President Trump likes to talk about drill, baby, drill. It's a mantra. Do you expect, Rob, to see a meaningful pickup in domestic production given where oil prices are at?
Well, from a macro perspective, Josh, we do expect the U.S. to continue to be the largest energy producer in the world. The U.S. has been in that position for a while. We do expect the U.S. to continue to be the largest energy exporter in the world. That's on the long term. In the short term, actually, we may be going the opposite way. With oil prices approaching $50 or being in the 50s in the U.S., I think you're hearing a lot of producers say that they are looking at, they're reevaluating really their capital expending programs. Right now, they're kind of holding them steady, so that might result in a little bit of production growth. But companies like EOG actually reduced their capital spending just a little bit. That means their growth won't be quite as much. In fact, they may decline a little bit. So if oil prices go in the 50s, which is where we think they're going to go, oil demand or oil production growth in the U.S. is going to stall and be flat and may even start to decline a little bit.
So does that then also provide a bit of a floor under oil prices?
Yeah, we think so. Yeah, we think so, Julie, because for that reason, like you said. So basically, oil's got to find a floor to get supply and demand back into balance. What $50 oil tells you is that the oil market's oversupplied, and there's too much supply. So we think, to get that market back into balance, you see less production from the U.S., possibly more demand because of increased driving activity and other consumer and economic activity, and that'll get oil back into balance, and we'll see oil prices come back into the 60s at some point. That's probably the better long-term average, is $65 to $70.
Rob, good to catch up with you. Have a great weekend.
Thank you. You too.
Thanks. Warren Buffett's Berkshire Hathaway gearing up to report its first quarter earnings and, of course, have its big meeting. We'll break down what to expect and take a look inside of Buffett's top holdings on the other side. More market domination still to come. Berkshire Hathaway's annual shareholder meeting is on deck this weekend. Here for a closer look at its holdings is Yahoo Finance's head of news, Miles Udland, here with us in the studio. Miles, we always look ahead to this meeting to get more insight into what Berkshire's holding, what Warren Buffett is thinking. Mm-hmm. But talk to us about the top holdings and kind of as a scene setter, if you will.
I mean, it's really just a story about Apple. I mean, we got the earnings last night, and the company comes out. They say it's going to be almost $1 billion headwind in the current quarter, and they wouldn't go beyond that. So, stock's down today. Buffett's largest position, even despite the he's sold 2/3 of the position over the last couple of years. So down significantly, but still the largest holding within Berkshire's equity portfolio. So certainly a lot of questions there. There'll be a lot of questions about Berkshire's overall tariff exposure. I think what Buffett himself makes of tariffs, because there was a Fortune op-ed, I believe it was, from the early 2000s, where he was like, China entered the WTO and we don't really have any domestic manufacturing. We should probably look at that. And maybe tariffs aren't all bad. And I would imagine questions along those lines and Buffett giving answers along the lines of, it's not necessarily the diagnosis here, it's some of the approach, which I think is a common theme when it comes to discussing tariffs. So we'll certainly get some of that. And I think what we heard from Apple last night is basically kind of why he has paired the position, but also why he still owns it. Company comes out, $100 billion stock buyback. They raised the dividend again, so Berkshire's getting a ton of cash, and they're getting a larger share of Apple just mechanically by owning the number of shares they do, and the buyback cancels some of those out. So that, I think, on the equity portfolio is the main line of questioning, though. As we get towards the end of the line for Buffett, I think that portion of Berkshire Hathaway just becomes less interesting.
What about that cash pile he's sitting on? More than $300 billion. Yeah. The fact that he's sitting on that, are there broader lessons learned for investors that we should take away from that, Miles?
I think the lessons are pretty clear. He didn't have a lot of other uses for that cash, and a lot of it's parked in T-bills. So you're getting, depending on the tenor, 2%, 3%, 4% wherever you're parking that, and that's not nothing at $300 billion worth of cash. So I think that's certainly part of the conversation for Berkshire. And look, the problem that Buffett and Berkshire have had, and this is never going to change now, whether Warren's running the company or not, is they're now too big to do a lot of things that make an impact on the overall portfolio. Like, they came into Apple, it's going to be 9 years since they first initiated the position. And at that point in time, you might know better than I what the market cap of the company was. It was smaller, but it was still among the largest in the market at that time, has been among the largest in the world for the entire 9-year period, and is kind of the only company big enough that can handle Berkshire coming in with huge buys on a very regular basis that doesn't, and that money on its own doesn't push around the price of the stock, because that's the problem when you're sitting on $300 billion in cash. They haven't bought a lot of companies outright. They did the Pilot Flying J deal a few years ago, but they haven't really been acquisitive with the money. So sure, are they going to buy Coke outright? I don't see that happening. They're going to buy American Express. I don't see that kind of thing. I could be wrong, but it just has not been the Berkshire Hathaway really since the Precision Castparts deal in 2015. They haven't done anything big. So what are they going to buy? I mean, they bought Japan trading houses. They could go buy shares of something else. But when you have that amount of capital sitting there, Buffett clearly doesn't see anything that he loves, that he wants to deploy new capital into. So you see that you see that cash pile grow. The interesting thing about this timing always is that we'll get the 13F from Berkshire in the middle of the month, so about a week and a half from now. So he may be doing stuff like this happened with Apple. He did the annual meeting, didn't say he bought Apple. A week and a half later, it's like, oh, I bought a ton of Apple, bought 10 million shares of Apple. So we might have a situation like that, but ultimately I think it's just a portfolio that reflects an investor who doesn't see a lot he likes, and it's new money. You know, we talk on the shows a lot with portfolio managers who are in the market. They have to do something, right? So it's like, do you like this more or less than your other options? For Buffett, it's new cash. So it's very hard to go from zero to something in this kind of environment, no matter who you are and whatever you're looking at.
All right, busy weekend for you, Miles. Thank you, appreciate it. For more on Berkshire Hathaway's upcoming shareholder meeting and what to expect, we have Bill Stone now, Chief Investment Officer at the Glenview Trust Company. Bill, it is good to see you. So Berkshire earnings on deck. I'm curious, Bill, what are you looking for? What are you expecting to hear?
So I think the big picture is it's kind of easy to predict, and you talked a little bit about it earlier, the cash pile. So just because of the $330-some billion cash pile, you are guaranteed essentially to have a very large amount of interest income. And that's probably the biggest thing that will likely overwhelm everything else. Then you got to look at, okay, how many catastrophe losses did they have from the LA fires? Again, I think the cash pile will overwhelm that, or the income, and they probably did some pretty good underwriting otherwise. After that, I'm going to be delving into really the status of Geico. They've started to seemingly get growth again out of that business. So I'll be interested to hear if that continues and where it kind of stands in its turnaround. And then lastly, maybe two things, BNSF. They've done some good work in making that railroad more efficient. Want to hear where that is. And then really last but not least, Berkshire Hathaway Energy, which is obviously a big piece. They're up against relatively easy comparisons, so that actually should look pretty good as well.
Bill, as an investor, are you disappointed that there hasn't been more active investment going on?
It's always a hard answer because I think, yes, I mean, in the sense of I would love him to have gotten more opportunities on one hand. But, he's picky, and that's been a good thing over time. I think he's still waiting for another big opportunity, obviously, like always, and he's got the cash to do it. So, I think most likely we're not going to hear anything at this meeting about something big they did. I guess it's always possible, but I'm not holding my breath on that one.
Also, Berkshire has not bought back any stock since May 2024 per Barron's. And of course, the Oracle value investor, price conscious. But what do you see ahead in terms of potential capital return, Bill?
I don't think you're going to see any buybacks in this quarter either. I think that's, I say it's not a disappointment. It is. I mean, I loved the stock was way more attractive, I say, for investors when you had kind of that double-barreled move of, growing operating income within Berkshire Hathaway and them buying back shares. It was really potent. Now you really just have to, at the moment anyway, count on the growing of operating income, which I think they will continue to do. It's just that, you'll have to, it's kind of like a lot of things, you'll have to wait for a better opportunity in Berkshire to see that get back to buying back shares. I guess, again, it's since we already own a lot of Berkshire, it's like you don't really want to root for that, but it'll take the stock kind of falling, or at least earnings kind of running for a while without the stock going up for that to happen, I think.
Bill, there's a lot of anticipation about Buffett maybe weighing in on the macro environment, right, on tariffs, et cetera. What do you want to hear from him, or what would you ask him on that front?
I guess I would try and be as sneaky as possible. And I guess it's not really sneaky is not the right word, but I suspect he's going to try and not answer, politically speaking. But I think if you asked him what's the impact of tariffs on Berkshire Hathaway's businesses, you might get the actual answer, right? Like, I think he tries to be very diplomatic about it. If Charlie Munger was still here, you might get a more straightforward answer. So I think that's the way I would go at it if I had a chance to ask him.
Bill, finally, Bloomberg had a good piece today, how the Buffett indicator, so this measures the ratio, total value of the U.S. stock market divided by the total value of U.S. GDP. Bottom line, Bill, it's at its lowest level since early September, so perhaps signaling equities are relatively cheap here. Bill, I'm just curious how closely you follow that Buffett indicator.
I don't, because I don't think he's spoken about it for quite some time. I think he's, to be honest, kind of left that behind. And I think there's good reasons for that. I think with particularly U.S. companies, let's just focus on that being so international. It's not particularly helpful to look at it versus just U.S. GDP. You've got something like 40% of revenues for S&P 500 coming from overseas. So I'm not sure, like I said, I don't recall him talking about it in quite a number of years. So I'm suspecting that, he may not really be focusing on it either.
Bill, thanks so much. Have fun this weekend.
Thank you, I will.
It's the seasonal adage that investors love to debate. Sell in May, go away. Yahoo Finance senior reporter Alexander Canal joining us now to break it all down for this week's Investor Playbook.
Yeah, sell in May, go away. It's a long-time Wall Street saying and suggests investors sell their stocks in May and sit out the summer months when markets are traditionally sluggish. But this year, some strategists are saying it might not be as simple as that. Take a listen.
I think we're in a different market this year, so I can't say that sell in May. I think historically, if we go back over the past 10 years, sell in May hasn't actually worked too well. I think this is a very high volatility news-driven cycle.
Just because it has some statistical significance doesn't mean it always works, right? Mm-hmm. So in a situation where we've had markets move up and down quite a bit, it's questionable on whether that can be a factor.
We have had a nice recovery in April, from that standpoint, which is great to see, but that certainly means we could retest some lows here. But that's not enough evidence for us to recommend, selling in May and going away, as they say.
For a bit of background here, this strategy proved effective during the early days of modern Wall Street, so think roughly 1960 to the late 1980s. But things started to shift after the market crash of 1987. It was around that time that a fully invested strategy began to outperform, and staying invested through the summer months became much more favorable. Now, historically, the S&P 500 has posted its weakest average returns between May and October, just 1.8% since 1950. That compares to a much stronger November to April period. That being said, summer returns have been positive 65% of the time. So it's really that relative basis reinforcing this trade. But again, doesn't seem to hold up this year since we have everything from trade talks to monetary policy impacting markets these days. And as we just heard from those Wall Street experts, staying in the game could actually be the smarter move amid a lot of this volatility. So we'll have to continue to wait and see, but sell in May, go away, not really holding up this year.
Well, we'll see. We're only on day 2.
Exactly.
Give it time. Thanks, Allie. Footwear giants like Nike, Adidas, and Skechers are among 76 footwear brands that are asking President Donald Trump for a tariff exemption. The Footwear Distributors and Retailers of America trade group sent a letter to the White House earlier this week saying that, quote, many orders have been placed on hold and footwear inventory for U.S. consumers may soon run low. They say in the letter in particular that low-cost shoes that Americans rely on for their families would be at risk and that there are already existing tariffs on some of this footwear. And so the new tariffs are coming on top of that.
I thought it's interesting too. What does Trump want? The president wants more stuff made here. He wants more stuff manufactured here. And I thought it was interesting in the letter how they go right at that point. They say these tariffs will not drive shoe manufacturing back to the U.S. They talk about how it takes significant capital investment. It takes years of planning to shift sourcing. The new tariffs, in fact, they say, remove the business certainty that is needed to make these types of investments and erase almost all the necessary capital.
Yeah,
so kind of directly addressing that point.
And also, they say there's also a reciprocal tariff on the machinery and materials needed to make footwear in the U.S. So if you wanted to build a factory here, you're going to get tariffed on importing that stuff to build the factory. So interesting. We'll see if he listens. And as we heard Greg Dacko say at the top of the show, small businesses that, so it'll be interesting if some of these large businesses get exemptions. Because small businesses don't have that lobbying power to try to push for this kind of thing.
See how it lands.
Yeah.
While we are wrapping today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.